Ben Reppond. Welcome to my YouTube broadcast. Today is February 14, 2024. I want to cover what I think was the direction of the market right now, and then I'm going to get into the charts and graphs and detailed dashboard and so forth. My view of where the market is going right now is it has been in an uptrend for about 3.5 months. And so it looks like from here it's going to continue for a while. But I will say my view is that based on historical patterns, it is not going to the moon. It never has, and it never will. It will at some point correct. But because it is in a trending mode, I have said since we got invested in early November, I have said, you know, we're invested. It looks like it's going to continue to go higher, and it has. And it may continue to go from here. Right now, it is experiencing the momentum. So when that stops, then my answer will be different. But for now, it is, at least for now, onward and upward. Okay, I want to get into the dashboards. The first dashboard are 6 indexes, 4 U.S. and 2 foreign, and the long-term government bond. So when you look at this, the top 6 rows to the right are all green dots. What that means is that these indexes, these ETFs, are above their 20, 50, 100, and 200-day moving averages, all of them, all 6. And so that's a very positive indicator. Government bonds, the long-term government bond, the ETF TLT, is not. It is below 3 out of the 4. So it is very weak, and 60-40 portfolios are made up of stocks and bonds. And this is not the only bond out there, but it's the long-term government bond. A lot of times people will buy corporate bonds or intermediate term bonds. But this is down. It's not only down, but it's down 5% year to date. So it is likely that with 60-40 or buy and hold portfolios, that they are maybe break even, maybe slightly positive year to date, and I mean slightly. Some could even be negative, depending on how they're constructed. But in the pink box, you see these are year-to-date returns. So what you've got is the NASDAQ 100 is up 6%, the S&P is up 5%, the Dow is up 2%, and everything else is negative. Long-term government bonds are down 5%, but the the developed markets, the emerging markets, and the small cap U.S. stocks are all negative. Okay, shifting to the sectors, in the S&P 500, there are, in the stock market, there are 11 sectors, broad industry segments of the economy. And in the pink box are the year-to-date returns of just through not even a month and a half. The technology is up 7.98%, healthcare up over 5%, financials almost 4%, industrials 2%, and so forth. And so there are 7 out of the 11 that are positive. There are 4 sectors which are negative, and the most negative are basic materials and real estate. When you go to the right of that and you look at the dots, the green dots means they're above their 20, 50, 100, 200-day moving averages. A lot of green dots. There are actually 36 of them out of 44. Last week there were 39, so slightly less, but that doesn't mean the market is negative. It just means there were 36 out of 44. And you can see the red dots, 3 of them were in energy, 2 in telecommunication, 1 in basic materials, and 2 of them in real estate. Okay, the S&P 500, when you look at 18 months, about 17 of those months are positive. Look at the direction that it has gone. So it has moved up and down, but by and large, in that 17-month period, the market has basically gone positive. So if you're experiencing positive returns in your portfolio, this is a surrogate or an indicator of what's probably driving that. When I split the market into two components, value stocks and growth stocks, and I put those on a relative strength chart, growth numerator, value denominator, when it goes up, it favors growth. When it goes down, it favors value. So you can see in an 18-month period that the market initially went down, then it went up for a while, and then it went down, and then at the very far end, in my red arrow, it went back up again. So there's 4 macro or intermediate term moves of the market over that 18-month period. And so our approach is to try to take advantage of growth and value when they come into favor. Like, for example, when value came into favor in the last few months of last year, we went into value. When growth came into favor this year, we went into growth. So it optimizes our return by using that approach. The S&P 500 on a relative strength chart, large cap stocks are compared to small cap stocks, IWM, the Russell 2000 small cap index. So when it goes up, this favors large cap, large companies, and when it goes down, it favors smaller companies. So you can see it has gone up and down, but by and large, since March, it has mostly gone up, favoring large companies. The long-term government bond ETF is TLT, and this is not a relative strength chart, this is an absolute chart. And so you can see over a 4-year period of time, the direction that bonds, long-term government bonds, have taken. Now, if I were to show you a small, the short-term bond or the intermediate-term bond, they, in general, have moved in the same direction. Their movement, because they are shorter duration, is not as much, but the direction is generally the same. So yeah, at the very end, there's a tick down, so bonds did not have a good week, and they have not done well since December. So, and then of course for the 48-month period, they haven't done well either. So when bonds go down in price, what that means is that they're sensitive to interest rates. So when interest rates are, I'll just use the Fed funds rate, the overnight bank rate, let's just say that when that rate goes up, generally speaking, the bond prices are going to go down, and vice versa. When it goes down, then bond prices are going to go up. Or there is the anticipation that that's going to happen. So the anticipation will sometimes drive the price before the actual interest rate changes. The dollar, the US dollar, represented by the ETF UUP, this is a 30-month chart, has generally over that period of time gone up. There are ups and downs, but the current short-term trend and the intermediate-term trend is up. That means that when we, who use US dollars, are buying things abroad, services or goods, that our dollar goes further. When they are buying US products, it tends to discourage them because their currency doesn't go as far as the US dollar does in other countries. Gold had a tick down, you see that at the very end, but since October, November of 2022, gold has been in a general upward trajectory. Same thing with silver, generally been in an upward trajectory since early October of 2022. However, silver has not gone up as much as gold has, and it has, it's below its 20-period moving average, and it has struggled a little bit. It's not, it's in a longer-term upward trajectory, but for the shorter-term period, it's probably even more negative than positive. When I compare the two, and I put silver as the numerator, gold as the denominator, and look at relative strength, if this goes down, it favors gold, the price of gold. If this goes up, it favors the price of silver. You can see since the late 2022 that the direction has clearly been down, favoring that gold has performed better than silver. Bitcoin has been doing very well since November of 2022. It has been in an upward trajectory. Ups and downs, in my opinion, is correlated to nothing, and it does its own thing, but definitely has been moving up. The volatility index has come down, indicating that there is less downward pressure or downward volatility in the market. That's generally a good thing for equities. I put the black mark on 24 as my arbitrary line. When volatility moves up through 24, usually it heads higher, and equities tend to go down. But that is not happening, and so it is, again, a period favorable to equities. Asbury Research comes out with their indicators, 6 of them, and all 6 of them are positive. 2 last week were negative, and now they have moved to all positive as of this past Friday. Their relative performance chart, comparing one asset or type of equity to another, I'll go over that. So stocks are more favorable, and the 3 columns are the last week, the last month, and the last quarter. Stocks in all 3 categories, these are all of them are going to be all 3 categories, are more favorable than bonds. High beta is more favorable than low volatility. The broad market is more favorable than the blue chips, the Dow. Tech is more favorable than the broad market, the S&P, and growth is more favorable than value. U.S. is more favorable than developed markets, meaning mostly Japan and Europe, and high yield has performed better than corporate bonds, and short-term bonds have performed better than long-term bonds. All of this matches with, almost all of it matches with data that I just showed you. Now when we compare the U.S. versus the world, remember I said, how strong the U.S. is relative to other markets. This shows this. So this is 21 countries or regions, and on a relative strength basis, which one is performing best? The U.S. in almost all cases is performing better than all of these 21, or nearly all of these 21 countries or regions in the last week, the last month, and the last quarter. So when you saw that chart of SPY, the S&P 500, going higher and higher, seemingly into the stratosphere, the rest of the world is not. And so this illustrates how strong the U.S. market is relative to those other markets. I picked the last couple of weeks, I picked France as a comparison to the U.S. So again, a relative strength chart showing which one is stronger, the U.S. or France. U.S. is the numerator, France denominator. So when it goes up, that favors the U.S. When it goes down, that favors, in this case, the country of France. So you can see from 2022 through early 2023, the U.S. was doing worse than France and probably other European countries as well. However, kind of in mid-April of last year, so this is about 10 months ago, the U.S. market took off relative to France or to other countries or even European countries, and has continued mostly in an upward trajectory. Okay, gold and silver. So the price of gold went down slightly, about 0.7% from the previous Friday, February 2nd. So these prices are of February 9th. Silver is $22.74 spot price, unchanged from the previous week. And the gold-silver ratio, gold numerator, silver denominator, is 89-1. And that favors silver as a better value because it is down relative to gold. So if you buy a monster box, that's 500 generic rounds of silver. The price is $12,490. That includes the spot price of $22.74 plus the markup of $2.24, bringing the cost per round to $24.98 for that box of 500, and it's a little bit higher for just one tube of 20, and that's $25.48. And that's based on the prices I get from my son of what he sells it for, but that's a good indicator for market prices. My investing club has been meeting for 4 years. So far, we've invested $500 in stocks, $100 in bonds, and $3,000 in coffee and cake. I hope you're doing well with your investments. This has been a good period for those invested in equities, and I hope that includes you. If you have questions or comments, feel free to leave them in the comments section below.